the impending $10 trillion issuance of new treasuries and its impact on the bond market. In recent times, there has been a perception that the worst of the bond market turmoil is over, with treasuries rallying and interest rates dropping. However, the next few minutes will argue the bond market turbulence has only just begun, and we are likely to experience years of higher rates and inflation. One imminent concern is the unwinding of hedge funds trading treasuries, known as the basis trade, which could further stress the US Treasury market. Additionally, the US government is set to issue approximately $10 trillion in new treasuries this year alone, which will have significant implications for the market. Over the next few minutes, we will explore the reasons behind this massive issuance and its potential consequences. The basis trade and hedge funds' role. Hedge funds have been providing liquidity in the US Treasury market through a trading strategy called the basis trade. This strategy involves buying one security and shorting another similar security, taking advantage of the price difference between them. By leveraging this trade, hedge funds have been able to generate seemingly risk-free profits. However, the extensive use of leverage in this trade has built up significant risk in the financial system. Attempts to regulate this risk could potentially trigger an unwinding of the basis trade, further stressing the Treasury market by reducing liquidity. The $10 trillion Treasury issuance. In 2024, the U.S. government is projected to issue approximately $10 trillion in new treasuries. This issuance includes new borrowing and borrowing to replace existing debt. The projected deficit for 2024 is around $1.4 trillion, meaning the government will need to borrow an additional $1.4 trillion to cover the gap between spending and tax revenue. However, the majority of the $10 trillion issuance is to pay off maturing debt, which amounts to around $8.9 trillion. Even if the government did not borrow any additional funds and ran a balanced budget, they would still need to borrow $8.9 trillion to pay off the maturing debt. Implications for interest rates and inflation. Despite the recent drop in U.S. government bond interest rates, the long-term trend suggests that rates are likely to rise due to the substantial borrowing needs of the government. This increase in borrowing, coupled with the potential return of quantitative easing by the Federal Reserve, is expected to lead to higher inflation. As the government borrows and spends more, the money being injected into the economy will drive up prices. Private lenders, such as mortgage lenders and credit card companies, will demand higher interest rates to compensate for the increased inflation, resulting in higher borrowing costs for individuals. The long-term debt cycle. The current situation aligns with the long-term debt cycle, which follows a 40-year pattern. The cycle involves inflation and interest rates moving higher for 40 years, followed by a period of lower rates and inflation for the next 40 years. The previous phase of low rates and inflation ended in 2020, indicating that we have entered a new phase of higher rates and inflation. This aligns with the long-term U.S. debt-to-GDP cycle, which suggests that another deleveraging is due either through deflation or inflation. Given the government's historical preference for inflationary measures, it is likely that inflation will be the chosen path. Conclusion. The issuance of $10 trillion in new treasuries this year, coupled with the potential return of quantitative easing, is expected to have significant implications for the bond market, interest rates, and inflation. While recent headlines may suggest that the worst of the bond market turmoil is over, this video argues that the turbulence has just begun. Investors need to be aware of the risks and consider hedging strategies to protect their portfolios from the potential impact of higher rates, inflation, and market crashes. Financial education and understanding risk management techniques are crucial in navigating these uncertain times.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.